Mr. M. Damodaran, a distinguished IAS officer, has held many coveted positions in the central government and was the Chief Secretary of Tripura. He was also the chairman of SEBI, UTI and IDBI. After successfully leading the turnaround efforts at UTI and IDBI, he was instrumental in initiating many regulatory reforms in his role as the chairman of SEBI. He was also elected as chairman of the EMC of the International Organization of Securities Commission, and he is the founder of Excellence Enablers Private Limited and passionately contributes towards enhanced corporate governance practices and improved board performance. He is an excellent orator, and we look forward to listening to his insights today. Ladies and gentlemen, please join me in welcoming Mr. M. Damodaran, Chairperson, Excellence Enablers Private Limited, former Chairman SEBI, UTI and IDBI, to deliver our keynote address to this August gathering.
Thank you, Neelam, and good afternoon, friends. First of all, let me express my gratitude to my old friend and colleague. Not that he's old, but the friendship is old. Old friend and colleague Imtiaz, for inviting me to take part in this colloquium. I listened with great attention to all of what he said, and my takeaway is that the organization that he heads is going to be in the vanguard of not just the resilience, but the positivism that will drive the future. And I'm delighted that I will get to hear some more of what the future holds for us, the anticipation that he talked about, the preparedness that he hinted at, and the planning that will go into making the future better than the present. But most of all, I was impressed by the theme of the colloquium: investing in a post-pandemic world, and there are two huge positives there for me. First, I noticed that we are already talking in terms of a post-pandemic world, almost as if we have put the pandemic behind us. I do not know whether that's the right position to take when you are seeing some numbers and some pronouncements that seem to point to, if not a fully blown second phase, certainly an increase in the problem that we have grappled with for more than 12 months, and an indication that it's going to take a little longer to put that behind us. So it's hugely positive to see that we began talking about a post-pandemic world. The conversation not so long ago, maybe a month, 2-3 months ago, was how do you survive in a pandemic world? Today we are talking about investing in a post-pandemic world. And I think that's the way to go. That's the way to think. That is the way our minds and our hearts will lead us on a journey where we leave the negatives behind and contribute to the growth and the welfare of not just the nation, but also the large number of people that reside therein and those that are underprivileged and need some amount of handholding. Talking about investing in a post-pandemic world, I expect the basics haven't changed. Investors look at three things, whether you're rich or poor, small investor, big investor. You look at liquidity, you look at returns, and you look at safety. And the order, of course, is dependent on who you are, what your financial condition is, what your risk-taking ability is. That will determine the batting order among these three, but these three will not go away. They will play some small part in the mental makeup of persons that invest, whether it's a pre-pandemic world, a pandemic world, or a post-pandemic world. There is also a behavioral aspect one needs to look at, and this is what I have heard from my conversations with people, old and young, in the course of the last 12 months. There is a segment of the population which has begun saying, I believe they are right. I hope they are right. We have seen the worst. Post World War II, there has been nothing of the kind that the whole world grappled with over the last 12 months. We've seen that. Nothing in the future, no matter how complicated it is, no matter how pervasive its negative impact is going to set us back, because we've discovered that we can conquer COVID and put that behind us and go on with life. What can deter us? Nothing really can. And therefore, that seems to be translating into an investing behavior which says, now there is no fear. I know that the elements I have to grapple with are those that I will not just measure up to, but I will put down and conquer. And so let us live as if there is no threat, there is no challenge, and the only challenge is understanding the various investment options that I had, choosing among them, prioritizing, allocating funds among various asset classes. That is the real challenge. The rest of it, I know Rahman mentioned that health is the most important, yes, but alongside that, this would remain the other major challenge for those who have investable surpluses. Sometimes it's not a good problem to have. It's like the Indian cricket team, a wealth of talent, you don't know what your final playing 11 ought to be. And then you take some decisions and sometimes it comes up wrong, and then the Twitterati go to town saying what you should have done in order to avoid inglorious defeats. That's the kind of problem that people with investable surpluses have. On a lighter note, if I may, I was once asked several years ago, what was my investment philosophy? And I said I never had to grapple with it, because the starting point for an investment philosophy is the ability to invest, and the government in its wisdom did not leave me with that problem. So I had no issue with what do I do with a surplus that was non-existent, where do I invest that? But there are people who have to grapple with that problem. And therefore, it is really the COVID-induced behavioral pattern that is the additional element which will influence the investment philosophies of persons. One end of the spectrum I described to you, we put it behind us. There is going to be no problem this big. But there is also another element that you can't entirely discount, and these are the people who ask in that very simple Hindi question, Kal kisne dekha? Why should I do anything that is going to get me returns in the future, making me prosperous? I don't know what tomorrow holds for me. And if I don't know that, why not I live as if today is the last day in the history of the universe? There are those people too. And their behavior also conditions the way they look at things. I know some years ago there was an oversimplified philosophy. If you are a young man, your investments should capture more equity. If you are old, you should look more at debt and less at equity, because your risk appetite might go down. All those stereotyped models have been, I think, blown out. There are older people who invest more. There are inequity. There are younger people who prefer to play safe because maybe of their personal experience or their conditions or the circumstance. One additional element that has come in the last few years, and this is a hugely positive element, that in the olden times you did not have an adequate number of investment advisors. You had product pushers masquerading as investment advisors. So depending on where I got my maximum returns from your investments, because I induced you to invest in an asset class, I would recommend to you that that is the only one into which every 100 rupees out of 100 that you invest should go. The product pushers, but holding themselves out as investment advisors. Today you have qualified investment advisors who will sit across the table, look at your specifics, look at your aspirations, your in short-term and medium-term goals, and then customize your holdings to reflect your requirements, not the requirements of somebody else. There are more and more people doing that, and that too is going to influence investing in the post-pandemic world, if I may call it that. If you look at asset classes, there was a time when people invested in real estate as if there is no tomorrow. Every additional amount that was available got channelized into real estate. You thought that this would only go up, and that bubble burst at some time. It came crashing down. There were lots of red faces among those that advised that investment. There were lots of pale faces among those that were caught napping with that kind of investment. Then we had the gold story for many years, and gold has always been around. It will always be around because the yellow metal is considered the most defensive asset class on which the Indian middle class can fall back on in difficult times. But gold also, after a few months ago having promised a lot, has suddenly, as they say, water finds its own level, like that gold is seeking to find a level where there's not terrible excitement. I know these are times when some people will tell you that this is a good time to invest in gold. Gold ETFs are going to be the flavor of the season, etc. I don't know whether that is caught on with the average investor in India as yet. So those two asset classes have created problems. The debt instruments, yes, they give you a little more than the bank deposits, but the average Indian has still sort of preferred to stay with bank deposits, even though you get negative returns from bank deposits. If you factor in both inflation as well as taxes, you pay the bank for keeping your money. It used to be the case when banking got started. You kept your money in the bank and paid them for safe custody. In some sense, courtesy the low interest rates, we've come back to that. So I believe, given all of that, the right combination of products, not too complex for the investor to understand, and yet reflecting liquidity, safety, and returns in whatever order, not missold to the wrong investors, because that's another element that needs to be very firmly addressed. The right products for the right persons, and informed investing. And I must compliment UTI for the education campaigns that have been done, because an informed investor is his or her best friend. Being informed is the best defense mechanism. It is some kind of self-reliance that you promote. I know that being informed should not translate to all of it to direct investing. There should be some that go through the mutual fund route because you get the benefit of both research as well as diversification. But that said, I think UTI's efforts in this direction ought to be complemented, and I hope they reach the largest for the parts of India, the most distant corners, and connect in the local languages with those that need to be informed, educated, and in a sense enthused to look at the equity and debt markets as a possible investment option for their surpluses. We're also seeing several other things happening. Work at home is going to be around in the new normal. In what proportion workforces will stay at home or work in office is something separate companies will decide based on what they can do. That is one factor that's not going to go away. The other is investing in one's own house so that you know in bad times you have a roof over your head. A lot of people who were renting till now are looking at investing in houses. Clearly, that too would require investments of a high order. There is investment in health that is taking place, not the government investment, but investment in the individuals, in personal health, whether by remaining fit, remaining healthy, redefining the way you live, redefining your attitude to life itself. That too, in some sense, will impact the manner in which investing will take place. And then you also need to look at the amount of money that is kicking into the system. Central bankers have not just loosened the purse strings worldwide, but have, in a sense, reached a stage when uh, tapering off or shutting off the tap is going to be difficult after some time. Now, clearly, all of that will bring more money into the system. That money will drive various economic activities that will create prosperity, that will create demand, including the pent-up demand that was there but which didn't find expression. All of that will need products of the right kind. That will need distribution of the right kind. That would need what I call the 3 T's: technology, transparency, and trust. I believe these are the 3 things that the industry needs to bring to the consumers of financial products, so that there is no disconnect between what somebody tells you and what you get to hear. There must be absolute clarity on those matters. There is one last thought that I wish to share, and that is that when you conduct a colloquium like this and you have such an array of brilliant speakers, I wish I could cancel my next meeting and stay on till the end and benefit from the takeaways. When you do this, please convert these into actionable goals. The wisdom that is going to be shared with you in the course of this colloquium, convert them to actionable goals. Bring regulators into that conversation, because unless the wisdom, the collective wisdom that experience brings to bear is translated into regulations and products that have no disconnect with ground realities, you will not be able to get as much benefit as you would like to get out of this. The time allotted to me is over, and therefore I think I should wind up now by saying that I wish all of you who are in this conference good luck, Godspeed. May the force remain with you, and may you conquer those vistas where no man has gone before. Thank you very much, Imtiaz, for allowing me this privilege and this opportunity.
Thank you very much, Mr. Damodaran. That was indeed inspiring. We have time for a couple of quick questions, and to moderate this, I would like to invite television and print financial journalist and founder of Boom and India Spend, Mr. Govindraj Etiraj.
Thank you, Neelam. Mr. Damodaran, I'm tempted to ask some questions which go back to the past, as always, because they usually tend to set a precedent for the present. And let me start off by asking, your inability to invest then in what would be, let's say, more remunerative market instruments. Is that changed today? Are you still constrained as it were before?
I don't know what the law is on privacy relating to investment possibilities, but that said, old friend, yes, things have changed. Things have changed. Okay. I no longer work for a salary that shrinks in terms of its real value month after month. No, I don't do that. I do have less commitments on my funds and therefore more investment possibilities.
Right, and to that, you are investing in mutual funds, and maybe UTI is one of the many in your portfolio.
I have actually placed some money with somebody who is investing on my behalf. I've always believed that you should not think you have all the expertise on all matters of the world. So there is somebody who understands this better, does it much better. But let me share a secret with you. And I hope he's not on this conversation. After placing this money some years ago, and I got good returns. I'm not for a moment complaining. There might have been the odd blip, but otherwise I got good returns. But without the benefit of any research, any study, and I'm far too uninvolved in this to do any deep dive, Impressionistically, I invested in 4 or 5 stocks, and during the same period, I got much higher returns than the mutual funds gave me. I know it's not going to continue forever, therefore, like a wise man, I opted out of it at the right time. I continue to be invested in mutual funds, yes.
Right. Okay. So you spoke about fear and or the absence of fear, and maybe that is what drives, and maybe in many ways the root of entrepreneurship and business leadership is in conquering some degree of fear. The flip side to that is that fear can lead to recklessness, and I'm not talking so much about investors, but I'm talking about the companies who investors invest in. Any concerns there that, given our own experience, our own predilection to maybe take bigger leaps than what we should, and how investors should watch out for that?
I think in COVID times, one of the things that one kept on hearing was, whenever there is a challenge, there is an opportunity there. COVID is a huge challenge, and it has thrown up a number of opportunities for those who are able and willing to take the risks. But being able and willing to take the risks is not like throwing caution to the winds and saying, I have the financial muscle and this is where I'll go. You'll come to grief quickly enough. And I have never tired of saying this. When in doubt, go to the dictionary. You see the distance between greed and grief in the dictionary, not too much. If your pursuit of greed, is driven also by recklessness, grief is round the corner, a few pages down in the dictionary. I think there are opportunities, but to think that everything that seems like an opportunity needs an investment as of yesterday is not reflecting very well on those that take the decisions. The other problem is, if you live by fear alone and don't take any decisions, then you have a problem. As somebody said ages ago, not to go forward is to go back, because everybody other than you is moving. So if you stand still, you're actually going back, the relativity will kick in. And that famous statement, you have nothing to fear but fear itself. So if you can put that behind you, believe that yes, calculated risks are worth taking. And I'm fond of distinguishing between risk and uncertainty. Uncertainty is shooting in the dark. Risk is I understand the shape of the target that I'm shooting at. I know where I am. I perhaps have the right weapons to shoot. And yet, I actually get the, bullet or the arrow there. I don't know whether that risk has been conquered, but I would certainly say that this is a world where risk takers will be rewarded if the nature and extent of risk is reasonably understood at the commencement of the decision.
Right, and let's come to another subject that is dear to you, which is governance. Now, how do you see the level of governance in a very broad sense amongst the companies that are doing well on the markets, and potentially, therefore, they are doing well for the right reasons? And should investors, once again, particularly institutional investors, be checking some boxes, particularly maybe looking at how companies have either behaved or not behaved in recent times?
Let me take you back 10 or 15 years maybe. The world did not believe that governance added value to companies. When you spoke at that time of a governance premium, people laughed at you and said, show me the evidence. Not just in India, but elsewhere. I think over time we've got to a stage when persons recognize, yes, there is a governance premium that the market will attach to companies. And therefore, companies are doing more than they did before. I'm seeing progress. The direction of change is right. Are they moving fast enough? No, they're not moving fast enough. They need to do much more than they're doing at present. Also, I think this move from compliance to governance. I used to be a chess player in my young days, several decades ago. And I'm fond of using that as an analogy. Compliance is playing black pieces. The regulator tells you what to do, or the lawmaker tells you, and you do it. You're playing black pieces. You're responding, you're reacting. Governance is playing white pieces. You're doing the right things because you know it's right. Nobody's told you to do that. And that is what I want to see more of. Compliance is non-negotiable. If you're non-compliant, you do business to exist in the market.
Right, and you talked about what needs to be done in governance. So again, what should institutional investors be asking, or what are the areas that they should be putting greater pressure on companies, even better performing companies or well performing companies, in order to improve or have the highest standards of governance?
I think two or three things. When the first thing, of course, an area of disappointment, if I may call it that, is that in no AGM, forget the virtual world, even the physical world, when the AGMs are conducted, I have not seen resolutions on appointment or reappointment of directors being meaningfully discussed at the AGMs. I would like to see somebody stand up in an AGM and ask a question that your new candidate is a great guy, one of the best chaps in the country. How much time does he have for this company? Isn't he stretched? So one of the things is, and investors are asking that question, aren't you on too many boards? How much time do you have to commit, quality time? The second, of course, is the regulatory track record of the company. If the regulatory track record is a bit iffy, investors will shy away. And now, of course, ESG. What is your concern for society as a stakeholder? Are you having instruments? Are you having initiatives? Are you having interventions that actually promote ESG? I was reminded of an old energy company ad. It said, we haven't inherited the earth from our fathers, we borrowed it from our children. Can we leave it at least as clean as we found it? Until now, the track record is poor and we need to do much more. So I think investors rightly are focusing on not the talk on ESG, but walking the talk on ESG. Don't tell me we are fully committed to ESG is not getting you anywhere. What have you done by way of manifesting that full commitment to ESG, at least part of the commitment to ESG? That's another area that I think they need to look at. One other thing I would look at, and this is me in my bonnet just now, is if you have X number of directors in the company, there are some who don't sit on any committees. There are some who sit on all committees. And I think a good functional board, which is important for a company, is one where the committee membership is distributed evenly among members. I would never take a director on a board if he or she said, I join your board, but I can't serve on any committee. Say, thank you very much, find some other board. I want people to share the burden. That is something I would look at. Of course, I would look at who the directors are. What is the personal credibility? Because that will rub off on the company's credibility.
Right, and are you saying? I mean, we've got a minute or so more. But conversely, if a director, for instance, is not sitting on a committee, is that an alarm bell?
If a director is not sitting on a committee, I wouldn't call it an alarm bell, because basically what they're saying is, I don't have time for the committee meetings. Okay. Increasingly, committees are spending more time, meeting more often, and boards, perhaps they can attend, committees they don't seem to be. It is more the time. But what happens really is a lot of information is available in committee meetings that never ever makes it to the boardroom, and you suffer from that.
Right. Right, Mr. Damodaran, we've run out of time completely. Thank you so much for joining me here. It's been a privilege speaking to you after a while. Hope to see you soon again.
Thank you very much, gentlemen.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.